Contracts for difference, known as CFDs, are a very popular way of trading a wide range of financial markets. CFDs let you try and profit from price movements without actually having to own the underlying asset. In addition, they allow you to use leverage. Let's look at a simple example of a CFD trade. You think the share price of company ABC is going to rise. It is currently £500 per share. You buy 1,000 CFDs. This gives you an exposure of £5,000. 1,000 CFDs times £500 share price. Your broker provides you with 5 times leverage for CFDs on share prices. So here, you would only tie up £1,000 of your total £5,000 position value. In this example, if the price rises, you make money. And of course, if the price were to drop, then you will lose money. You can also try to profit from falling prices just as easily. Let's stick with company ABC. You think its share price is going to drop. You would open a trade by selling first. This is known as selling short. If the price falls, then you will profit. And of course, if it rises, then you will be making a loss. It is important to understand that using leverage will magnify your profits and losses. And if you hold a position overnight, then there will be a small funding charge to reflect the costs of leverage. With Capital.com, you can never lose more than your account balance. So when trading CFDs, you are safe from having your account go negative. Please remember that CFD trading involves risk.